You guys, CircleUp here is creating the BlackRock or Two Sigma of the private markets. So help us understand how you're going to do that.
Sure. So CircleUp is an investment platform powered by technology. We've built a technology that we call Helio, which is a collection of algorithms and data sets that go out into the world, find, and then evaluate consumer companies. So we focus just on consumer products. On top of that technology, we've built a series of funds, equity and credit funds. And effectively, you're right, we're trying to build the Two Sigma or BlackRock of the private markets. We're trying to build a systematic private fund that helps us strip out discretion in the private investing process.
Which is a big claim, big thing to try to do, and data's a big word. So what are you doing that's different from other firms, other private equity firms? What's your gathering process look like?
So it starts with the team itself. We've got about 70 people that work at CircleUp. About half of them are data engineers, data scientists. If you look at a typical fund our size, they will have 0 to 2 engineers. Typically, those data scientists or data engineers use fairly commoditized data, might be LinkedIn data, credit card data. Then it's what we do with that team.
Well, where are you getting it? So you're not getting it just from LinkedIn or credit cards.
Yeah.
Where's your data coming from?
Literally hundreds of sources. So in the consumer space, so when I say consumer, I mean food, beverage, personal care, pet products, things like that. In that industry, you can see where a company is sold. So not just that they're in Whole Foods, but specifically which Whole Foods, how many SKUs they have, the price points of the different SKUs, what the end users think of the product, and how all those things change every single month, and how they compare to all their competitors. There are factors, to use a term from the public markets, that have been shown to be predictive of future success. So we use those factors to first find companies and then evaluate those companies.
Okay, so you're getting really in the weeds. Why don't you give us an example that would help us understand better a deal that you've done, a company you've invested in, that you
Sure.
found from the data?
Sure. So a company called Liquid IV is a hydration company. Powder you put into water, sounds pretty simple. It's a company that we found when they were doing just a couple $1 million in revenue, and that company has grown at an extraordinary rate. It's grown by about 10x over the past year to 15 months, and they will grow dramatically again this year.
So who do you see as your big competitors then?
For us, it's every family office, every consumer fund. I mean, there's been a few panels here today about the private markets and the shift from publics to privates. The asset class, or I guess the industry within privates that's gained the most share of wallet over the last 15 years is consumer investing. So it's not really intuitive to most people, but it's an industry that historically has just attracted a lot of private capital. That private capital tends to be centered on kind of companies above 10 million in revenue. We focus below 10 million in revenue.
Okay, so smaller companies.
Smaller companies, these companies tend to typically get funding from individuals or family offices. It's cobbling together around, typically from dozens of entities or people.
Okay. So are you their first institutional
Yes.
backer generally?
Yeah, if you look at the 200 most successful consumer companies over the last 15 years, almost all of them did not have a single institutional investor before they got to 10 million revenue. Okay. So if you think about that, if you compare that to, let's say, tech, which most people know a bit better, in the tech world, that's like a Series D company. So it's effectively saying, here's an industry that's about 3 times the size of tech. It's averaged a 22% IRR for 15 years with half the volatility of tech, and it doesn't have 5 venture capital firms in the country that invest below Series D. That's the industry we focus on.
Okay. Well, let's zoom out a little bit, Ken, with you, with your background, Barclays, BlackRock. What do you see as the kind of broader move to private markets? How does CircleUp play into that?
So I think what I see and what I've seen in the last few years of my career, and it's nothing you don't know about, it's nothing you haven't heard about, is public markets are becoming private. Public companies are becoming private. Mm-hmm. Private companies are staying private, and the private companies are looking for all kinds of other ways to get funding without IPOing, without going public. I know I work for a number of sovereigns, just sort of advisor for various sovereigns, and many of these sovereigns, these are the entities that are sitting on hundreds of billions of dollars of capital. And they see the same trends we all see. So what they're doing is they're going to fill that gap. They are all, many of them, the ones I'm working with, are looking at providing debt funds for the private firms who want to stay private and don't want IPO. And what that means is the trend that we've all seen in the last 5 years it's got a lot of legs left. There's a lot of room left for private firms to stay private and never having to IPO.
So are firms like you guys and PE firms now essentially the new IPO? You don't want to deal with the public markets, the roadshow. You can go to a private equity firm or a firm like you guys. And
I definitely wouldn't say that we are. So we focus on earlier stage companies,
Right.
1 to 20 million in revenue.
Okay,
in
so
that-
they wouldn't be
in that
ready.
range. Yeah. Private equity firms, especially some of the ones that have presented today, that are able to invest in $2 billion companies, yeah, they're keeping companies private longer and maybe never go public. That's a long-term trend that we're not the first ones to talk about today.
Right, of course. Well, let's talk about something else that's come up today, which is ESG, diversity. What are you guys doing that you think is different from some of the bigger PE firms out there? We talked about this a little bit when we first met.
So we're making decisions based off of data, not just based off of human gut. And if you think about how private equity firms or venture capital firms have traditionally made decisions, it's a group of individuals who get in a room together and have an investment committee, make a decision on an entrepreneur. The decision on the entrepreneur gets more and more weighted towards that investment committee's personal connection with the entrepreneur, the smaller the company. So if you look at venture capital, it's usually about the CEO or the founders in terms of their decision. Now, I don't know if that's a coincidence that in VC, less than 5% of the money goes to women-owned companies or female CEOs. I think it's because the people that traditionally, and this is changing a little bit now, but traditionally have run those investment committees tend to be candid with you, older white men.
You look like me.
They tend to, well, they tend to fund people that look like they do. And we're trying to change that paradigm by making the decision, the sourcing and the decision, based off of data. So it's no longer, did you and I go to the same college? Are we friends with the same person? It's now, we just look at the data and make the decision based off of that. The result for CircleUp is about 65% of our companies are either women or minority controlled.
And that's huge.
It's a much bigger number. Now, to be frank, we didn't start off going to look for that. That's not our to be candid with you, our goal.
Right.
Our goal is to fund the best companies and the best entrepreneurs.
So you accidentally found out that some of the best entrepreneurs are women.
We
right?
really did. We really did. There is not a you will not find anywhere where that's actually what we're looking to do. We're trying to just make it a true meritocracy. The problem with Silicon Valley today is it's not. If you are a CS major from Stanford, you're going to get funded. By the way, the majority of them are also male, right? And that begins as a self-fulfilling prophecy. And we're in a category that is not actually dominated in terms of the CEOs and the founders. It's not dominated by women. It just so happens that the companies that we're finding that have the best data, I mean the best performance metrics, are often run by women.
So what's the next step for these companies that you're backing?
So in this industry, and this might be a little bit too much detail for this panel, but in this industry in consumer, every company every public company in consumer is losing market share to small brands. It's pretty extraordinary. 90% of the top 200 brands, or top 200 public companies in the world in consumer are losing market share. And the way they're responding to that is they're buying innovation. So it's a bit like big pharma, if you've tracked that category over the last 30 years or so.
Okay.
They outsource their innovation, then they buy it through M&A. And in consumer, that's what's happening. So last year alone, there's about $300 billion of M&A in consumer. So what happens is we invest in the companies and then we look to sell them. I mentioned before that in consumer, the private equity market, there's a lot of capital that's flooded in there. The problem is now that market is pretty darn crowded, which is bidding prices up. That's actually great for us because we come in earlier.
Okay.
But what we're also seeing is it's not getting crowded just because of those funds. The large strategics are coming down market and trying to buy companies earlier and earlier as well.
What do your critics say?
A lot. There's a lot. I'm sure there's some in the audience right now. First, if you talk to anyone who has ever worked at a private equity firm or a venture capital firm, they would tell you that this job cannot be done by computers. Now, they will tell all of the companies that they ever invest into to invest into technology, because they will point to every part of the supply chain or value chain, rather, of their companies and say, this can be done by technology, this can be done by technology, but their job is too precious to be done by technology.
What's your take on why?
I think they're the most arrogant group in the world. to be
Job
candid with you.
preservation.
Yeah, I mean, and by the way,
Yes.
I did that for
Love
most
it.
of my career. I think it's the most, they always think they're the smartest people in the room.
By the way, hold that thought.
Yeah.
When I was at Barclays Global Investors, we quantified the investment process in the public markets the same way CircleUp is quantifying it in the private markets. And I was around back at the beginning of that trend as well. And we heard exactly the same criticism that Ryan was talking about is, this job can't be done by computers. It has to be done by people. People need to meet with management and talk to management and get a feel for management. I can look into a CEO, I had one guy tell me, I can look into a CEO's eyes and I just know when he's lying to me.
Yep.
I'm not sure I buy that.
Yeah.
And we, I think, pretty successfully proved that you can quantify the investment process in the public markets, and you don't need to meet with every CEO out there to make investment decisions, just like CircleUp is doing.
It's in my career. So before this, I was working in private equity, focused in the consumer space. And I remember 11 or 12 years ago, I met with a CEO in LA who I flew down from San Francisco and met with her. First thing she says to me is, "I'm just really tired. I just don't know if I can do this anymore." And I'm thinking to myself, you don't want to tell that to me. Like I want to get on a plane and fly home now. Changed my flight. I flew home. She never ended up raising money. We passed. The data looks really interesting on this company, but you can't back a CEO like that. Turns out she never raised money, and she sold her business last year to TPG for $2 billion. A company called Anastasia. And I can give a dozen other examples where I made a decision thinking that I could read the tea leaves around this entrepreneur and I could predict this entrepreneur's success based off of not a lot of data and just my own gut. Another example is I met with a management team that would not put down their dog in the entire meeting. Had a little tiny, I don't know what it's called, just this size, would not put it down for 3 hours. That company was a company called Two Face.
And you judged them for that?
I did. How can you back a team? They're not focused on the meeting. And I did that. And the final example, which is also really relevant for consumer, in this industry, everyone thinks that they know the average consumer. We worked with a company a couple of years ago called Halo Top, an ice cream company, which at the time was about $1 million in sales. And if you talk to any investor in the world that tried this ice cream, they would say, you can't invest in this company. The ice cream doesn't taste good. Just does not taste good.
Sounds like a Shark Tank episode.
Yeah. And for those of you who have heard of the brand, it now sells more pints of ice cream in America than Ben & Jerry's or Haagen-Dazs. It was on The Bachelor last night, if any of you watched The Bachelor. And the point is that while it didn't taste as good as Ben & Jerry's, it tastes good enough. And it dramatically outperformed another dimension, which was just health. It had far fewer calories.
Right. So when you collect the data and it's telling you to invest in a particular company or a particular CEO, do you then meet them in person?
So we have a discretionary fund, which is informed but not instructed by Helio. In that case, we do. In the case of the systematic fund, which we're just beginning to raise now, it'll be a $375 million systematic fund. In that case, we will not need to meet them in person. We'll talk to them. There's other information that we'll get from them. We'll do a background check and things like that.
Right.
But we purposefully are not going to sit down and say, do I think Ken's a good CEO or not?
Right, rejudge.
Yep, we're trying to eliminate that process.
Okay.
And just to comment on that, that part of the process can be eliminated. I know that there are a lot of skeptics who say that you can't. That's the most important part, and you mentioned it earlier. But again, we heard the same thing back in the 1990s in the public markets, that's the most important part of the investment process. It's not the most important part of the investment process. There's information out there in the private markets, which I know there are skeptics saying there's not enough data in the private markets. There's as much data in the private markets as almost as much as there in the public markets. It's just not structured data. It's data that appears online, it's on web, it's text, it's pictures, things like that. But the data's out there to analyze these companies, and you can take the emotion and the human error out of the investment process and just let the data talk to you in the private markets the same way that BGI, now BlackRock, did in the public markets back in the 1990s.
And look, the data's ugly. It comes from hundreds of different sources. It is really hard
Tell
to
us a couple more. Text, pictures. I mean, you don't hear that every day.
Excuse me?
You don't hear about text and pictures being used to make investment decisions. What other sources of data?
So in the consumer space, there's a couple major factors we look at: distribution, brand, product uniqueness. So in the product uniqueness component, what Ken was referencing is one of the things we can look at is ingredient decks, nutritional profiles, which may sound to certainly a lot of public investors in here like a silly thing to look at. if you looked at the couple thousand ice cream companies that we track from afar, and you can just quickly sort on number of calories and identify that there's one company that has far fewer calories, as at least 4 or 5 years ago, than anything else, and was expanding distribution faster than anything else, and the brand scores, meaning how positively the consumer relates to that company online, were all off the charts. Those are factors we've been able to show are predictive of future success. So that's what we're able to get almost every single company in the consumer space.
So social media plays a big role, I'm assuming.
Social media does, but in the consumer space, one beautiful thing is that these companies don't live in stealth. There's no concept of I'm selling my product, but I won't tell you where or how much to pay for it. Everyone wants you to know it. When they launch in Whole Foods, they want you to know that they launch in Whole Foods, and Whole Foods wants you to know you launch in Whole Foods. And then Ken buys the product, he goes online, he talks about it. Whether it's social or reviews, there's a lot of different sources for that, but that information's out there.
Okay.
Unfortunately, it's across a lot of different sources, so it's really hard to cobble it together, but that's what we've been doing for years.
So is there a way to expand that, to invest in companies that aren't limited to consumer or retail?
A lot of quant funds think there is. There's a number of quant funds in the public markets, rather, hedge funds, hedge funds in the public markets that are investing heavily into trying to create private market strategies.
Okay.
Some are doing it kind of on a generalist basis. Some are focused on technology companies. Some are focused on consumer companies. But they certainly have a thesis that you can do this in a very big way, meaning take the lessons that they've learned on building a quant systematic approach in the public markets and bring it to privates. In our view, we look for a couple things when we think about where else this could work. We're looking for industries where there are similar business models. So in consumer, whether I'm selling you dog food, shampoo, or water, the margins are different, the basic business models are identical. It's very different than tech, where you've got a game for your iPhone, a securities business, cryptocurrency, wildly different business models. That's important because it's the same game of chess over and over again. The second thing that's so important in this space is there is a ton of data, just as we've talked about before, just an outrageous amount of data. If you contrast that to, let's say, tech, there's not nearly as much data as you can get on, let's say, Slack's performance their second year out. You can't get a list of all their customers and what they pay for it. You can get that in consumer. Okay. The third thing that we would look for is a lack of adverse selection, meaning if we build together a quant fund that focuses on technology companies in Silicon Valley, and we find the best technology companies, they're going to receive that email from us, and then they're going to go call Benchmark or Sequoia. There's no reason that they should take our money, to be candid with you. But in consumer, if you do Google search for early stage consumer product funds, they're all
going to take your phone call.
No, there aren't many out there. It makes it much easier for us to work with the absolute best companies out there.
Okay. All right, so we're down to the last couple seconds. What are the biggest risks out there when you look around? What makes you nervous?
I think probably what makes me nervous the most, to be candid with you, is LPs chasing the same.
Just same large funds?
No, just the same. Meaning that they saw all of their other friends at other LPs trying to invest into, for example, early stage tech, trying to do it as well. When you look at one of the previous panels had a chart on dry powder and the growth in dry powder. What we're seeing is that a lot of the LPs, many, are struggling to have the courage and conviction to be able to invest into something unique and different. So you think about what that means if everything's chasing the same, whether it's early stage tech in San Francisco or late stage buyouts, whatever it is, it's hard to make money doing that.
Okay. Ken?
I think the biggest risk in my mind is kind of execution risk. What happens, so we identify the 100 most out of 1 million companies, the 100 highest probability of success. Now, how do you actually go out there and negotiate a deal with each of these 100 owners? There's execution risk. It's a problem that we're working on. We'll solve it. Not a big concern, but there's a risk there.
Well, guys, thanks for your time. Thanks for helping us better understand what you do.